let's start with the biggest event that's unfolding right now, the Russia-Ukraine tension. How will markets react, let's say, if there is, a proper attack on Ukraine?
So every war of this kind will result in two things: the market sell-off, and there is a flight to safety. So, treasuries might rally. And the third thing is that oil prices typically spike up in such cases of geopolitical tension, where there are places where large amounts of oil are found, which is really obviously Russia. So any conflict of this kind will have these three effects. So what we are seeing right now, it is pretty a standard, let's say, recipe for what happens in case of war or near war situations.
And where do you see India in all this?
So India will suffer. India is not given, is some gifted country which cannot suffer the ravages of a global market rout. We are right in the middle of it. Even though Indians believe it, we are not on the same earth as the rest of the countries. The reality is we are just another country, just another market, which has good things and bad things. And in a bad situation, we will hurt as much as any other market will.
Millions of new investors entered in the market in the last 2 years, and they're not prepared for these volatile moves. For them, the stock market was this bullish place which only goes up, as you also mentioned in your tweet. So what's your advice then to these new investors now? What should they do?
They should welcome it. They should embrace it. They should kiss it if they could kiss it, because these are the invaluable learnings on a journey on a long journey, hopefully for most of them in investing, that you have to take the rough with the smooth. Markets are not going to be permanently bullish. And when they're bearish, they become brutally bearish. Their markets defy logic in terms of how far prices can fall. So everything in theory, when people look back and say, okay, market fell and then rallied, when you are undergoing that, when you're living that every second of the day, tick by tick, that's the real learning you take away as an investor or as a trader. So they should love it. They should not feel bad about it. They should thank the market for giving them this wonderful learning opportunity in which a huge amount of tuition fees will be paid by these little investors to the market. Hopefully, they will recover all of that back through these learnings over a long period of time.
Whenever we are, though, going through an uncertain period, volatility hits the small caps much harder. So how does one deal with this volatility while patiently waiting for these stellar returns to turn up?
Yeah, so whoever said that investing is an easy game, it becomes easy for some time. So when you go to a casino, okay, the casino makes you win the first few games. That's the way it is set up, especially the good casinos who have got a lot of data. And then one day and one fine hour, the game turns and you suddenly give up all that you gained and you give up more. That's the way the stock market is. I'm not saying it's a casino, but ultimately still a series of bets you take. Now, if you're taking a bet on Hindustan Lever, and if you took that bet in 2020 March, you were the most foolish person in the world, because the stock did precisely zero. Same with the banks and same with the most other FMCG companies. But if you were taking a bet on the small caps, you made five times, 8 times, 10 times your investment, right? Therefore, you are going to be forced to take additional risk in order to make additional return. And that area of the market is the small cap market. And in such situations, that will be the area of maximum damage, because they have done the best in the last 2 years' time. Now, if you've watched markets for 30, 35 years, you know this is part of a script. Nothing that is happening is unexpected. What gives you maximum pleasure will give you maximum pain. That is my favorite quote, and is a quote given, or invented by me. I'm very proud of it, because that really captures the essence of markets, that what gave you maximum pleasure, for the small caps, they're going to give you maximum pain, but the cycle will come back to the better companies there. And that's exactly where you're still going to make 5x, 10x of your money. You're not going to make that buying HDFC Bank or Hindustan Lever.
So any of these small caps that have caught your eye amid the ongoing correction then?
Oh, there are many stocks. Again, in small caps, it's a vast market. You have to fish carefully, because there are a lot of all kinds of dodgy companies. I would think more than 90%, 95% are dodgy companies. You might find 4, 5, 8 good companies if you're lucky. If you do a lot of work, if you travel around India, meet companies, get it from your network, do a lot of channel checks. All those are essential ingredients of making money in small caps, where you need a lot of informal sources of information. By just looking at a balance sheet, you will not get enough information. There has to be a very 360-degree approach to looking at such companies, which is labor intensive. I always said that making money in the stock market is not easy. It looks easy for a while, but it's never on a long-term basis that simple. Okay. And therefore, it will require more effort by investors to get to those 4, 5, 10, 15, 20 big winners. But they are right here. They're in the market. They might be falling 5%, 8% every day. They might fall a maximum of 50%. I think they'll be great buys.
Which sectors would you suggest that one must keep out of and the ones where people can invest in right now?
Well, I think IT services continues to be if you talk a broad, well-established sector, looks great. Without any doubt, those companies have great visibility, great management, whether large or mid or small cap IT. Choose wisely, of course. But with that caveat, I think that's a great place to be in. Chemicals continue to be a very, very attractive place. China plus one is very real. A lot of capacities will move to India, are moving already. That's a great place. So these two old line established sectors are extremely attractive. And then there are newer companies doing little small things here and there. Somebody supplying to some EVs and all that. There are, little pockets, which again, you have to choose carefully. But those pockets will also make you decent money if you have bet wisely on, let's say, 4, 5 stocks in that space. So there is plenty of choice in the market. Let me not give another picture contrary to what is the reality. I think the choices are immense.
You spoke about tech, you spoke about new companies, but what about new age tech companies? Because they've taken quite a beating in the recent past. So what's the view there?
Well, first they made victims of retail investors. Now they are becoming victims themselves. So what you sow is what you reap, as the saying goes. So I think it's okay. They sold their stock at crazy valuations. And I repeat, for the nth time, it's all credit to them. They did a fantastic job of creating a good story, a good hype, good momentum. Sold stock, which is what their job is, to investors, whether QIBs or FPIs or DIIs or retail investors, जिसको हम लोग बोलते हैं हिंदी की माल पहना दिया ऊपर में. अच्छा किया ना, माल पहनने के लिए आ रहा है तो पहनाना ही चाहिए ना. What is the big deal in that? So, they did a wise job. They did a fantastic job. And now the stocks are correcting. It's not their problem. It's the problem of the guys who bought them.
Okay. Both metal and realty sectors. Now, these are the two packs where we get a lot of questions as well from our viewers. They've seen a sharp fall if you compare them to other sectoral indices. Should one remain out of these right now? And if they've already invested, should they book profits, whatever they're getting, and exit immediately? What do you suggest?
I'm not a big fan of metals at these levels. I bought them in April, May 2020 when they were just coming out of the cycle, oil and steel and all those things. But, we exited, I think by March, April last year, we were pretty much out of it. We've never gone back into steel at all, even though numbers are very, very good. These are very, very cyclical businesses. And, at least our read was that the cycle has more or less peaked out. Or even if it's not peaked out, maybe we are one year away from peaking out, and which is good enough from my perspective. If you make 2x, 3x in a metal stock, that's more than what I want to make in these kind of companies. As far as real estate is concerned, I think the broad story in India is intact. Money will find its way from the stock market to the real estate segment. It has been unloved for a very long time. Barring, such volatility as we are encountering right now, I think well-chosen real estate plays will give you decent returns.
Gold is back, crypto is down. I know you're not someone who's very averse to cryptocurrency. You've already said in the past that one could look at a 3 to 4% of exposure, when it comes to digital assets. The Bitcoin gold comparison is perhaps as clear as it can be in today's situation. And just 2 days ago, there was a Grow survey that 45% hinterland investors are looking to deploy more money in cryptocurrency. What do you think about crypto, and what is it about cryptos that attracts Indians so much when the stock market has been around for so many decades?
I think it's just a new asset class, and anything new will be embraced by people who are younger rather than people who are older. That's axiomatic, right? That older people will say, this is all rubbish. And now we know a lot of my, fellow investors, my dear friends have said there's all rubbish. And even in the US, the old guys have said it's all rubbish, but that's their perspective. newer guys will adopt and adapt to change much quicker. So they like crypto as more their asset rather than their grandfather's or their father's assets or their mother's asset more appropriately. And therefore they flock to it. Doesn't mean gold is going to go out of business or that crypto is also a scam. I don't think either is true. Both will remain. Both will occupy a certain place in people's portfolios. Particularly for Indians, I think most people will still prefer gold for the perceived safety of it. But the newer age investors will say, no, I want something easily traded. I want something which has volatility like crypto. I can buy at 20,000, I can sell at 30,000, I can buy again at 15, I can sell at 25. Gold, you can't do all that. That's more a stable long-term store of value. So different markets and different people, it's just like two products for different segments of the investing class.
Okay. All right. Couple of more questions before we let you go. What are you most excited about the markets right now, and what worries you the most at the moment?
So what is worrying me right now is whether all the easy money policies that started after the GFC of 2008, and that cycle ran for 10, 11 long years, successively fueled by rate cuts, moderate hikes in 18, then again rate cuts after COVID. Whether whether there's going to be a complete reversal of what we have gotten used to, which is really easy money, cheap money, abundant liquidity. That is what is at the back of my mind, that have we gotten too used to this drug of easy liquidity and at a very low price, that the withdrawal effects of that will be very, very severe. I mean, that is what is my back of my mind. That is what is worrying me.
Okay, then, well, thank you so much, Shankar, for joining us and for sharing your insights and your reading of the market as it's playing out right now.